Good morning, Margaret and David. Thank you so much for joining us, the Caredom Financial Planning team, and especially me, Megan Fletcher, as we further discuss the tax planning section of your financial plan. I'd like to begin by saying that while I've taken the required courses to become a certified financial planner, I'm not a CPA or certified public accountant. Therefore, our firm has asked that your CPA sit in on this section. Welcome, Mr. Taylor, and thank you for joining us. While our main focus today is the planning section of the financial plan our firm has created, please note that taxes touch almost every aspect of your plan. I will cover those areas as needed throughout this presentation. Please feel free to ask questions at any time, as I would be happy to address them as they are still fresh in your mind. So let's dive in. To start, I've created a table that outlines your assets, some of which are current and some we are recommending you invest in. This chart will give you an idea of how each asset you hold is affected by taxes. Within the table, we have notated how each is funded with either pre or post-tax. And the final column shows how the expected returns are treated in terms of tax. Therefore, we have sorted this chart so that all pre-tax accounts are shown first. As you can see, your health savings account, traditional IRA, 457B, and pension are all pre-tax, which means that money is contributed to each account before taxes are applied. In terms of your health savings account, as long as you use the funds for medical expenses, you are never taxed on the money. This even applies to its earnings. However, your traditional IRA, 457B, and pension will all be taxed as ordinary income when you begin withdrawals or payments. The next section shows the post-tax accounts, which mean that you place money in these accounts after taxes taken from your paycheck. Your checking, money market, and savings accounts are also taxed when earnings are added. On the other hand, your Roth IRA returns will be withdrawn tax-free. Finally, your brokerage account will either be subject to ordinary gains when you have gains from holding a position less than 1 year, or capital gains if they are held longer than 1 year. Now that you have an understanding of your assets and how taxes will have an effect, let's move on to your current financial situation for 2019. See on the following slide, I've provided marginal tax brackets for 2019. As you are likely aware, your income tax is based on a progressive tax schedule, and the more you earn, the more you will pay in taxes. You currently reside in the 24% tax bracket, as your taxable income is within the $168,401 to $321,450,000 range. We have assumed that the tax brackets remain similar throughout retirement. However, please note that these can change due to the new tax laws, as they did in 2018 with the Tax Cuts and Jobs Act. Now that you have a general idea of the marginal tax brackets, we will move on to the breakdown of your current taxes. As you can see on the slide, here are the current 2019 tax figures that you have submitted at the beginning of our discussions. To begin with are your payroll taxes that will be paid this year. FICA stands for Federal Insurance Contributions Act, which is the federal payroll tax that goes to fund Social Security and Medicare programs. For 2019, up to $132,900 of your gross income is subject to the Social Security tax of 6.2%, and all of your gross income is subject to the Medicare tax of 1.45%. You will pay half, while your employer would pay the other half. As your individual incomes do not exceed $200,000, you will not incur the additional Medicare tax of 0.9%. Your payroll tax is followed by your property taxes. You submitted figures for both real estate and personal property, or your vehicles. Finally, your CPA has determined an estimate of the federal taxes that you will owe for the 2019 calendar year. As we have not yet made it out of 2019, this figure is likely to change, especially as you consider our recommendations, which brings us to our next slide on strategies to reduce taxes. For your particular situation, there are a few ways in which we would recommend to reduce the amount of taxes you owe for 2019 and beyond. The strategies listed on this slide are those that are considered above-the-line deductions. These recommendations reduce the amount of gross income that is reflected on your 1040 or tax form. The first option is to add funds to your current health savings account, or HSA. Currently, your employer contributes $1,080 every year, but your family is allowed to contribute up to $5,920 per year and even an additional $1,000 per year if you're over 55. As you qualify, this could reduce your income by almost $7,000. This option only makes sense if you plan to use all of the funds for medical expenses. Another option to consider is to establish a 457 plan and begin making contributions in 2020. We highly recommend this option as you can contribute up to $19,000 in 2019 and $19,500 in 2020. As you are over 50, you are also able to apply the catch-up provision, which allows you to contribute an additional $6,000 for 2019 and $6,500 for 2020. In total, you can add up to $25,000 in 2019 and $26,000 in 2020 on a pre-tax basis. Finally, this plan also allows for a special 457B catch-up contribution. When you are 3 years away from the normal retirement age, which for ERS is 65, you can contribute whichever is the lower amount between twice the annual limit, which is $38,000 for 2019, or the basic annual limit of $19,000 plus the basic limit not used in prior years. As we determined that this asset would be best in Margaret's name, the last provision would not apply because you turned 62 in 2024, which is the year that you both plan on retiring. Overall, contributions to a 457B plan would be beneficial as it lowers your gross income for the tax years in which you are employed, and it allows you to continue to save for retirement. This account will also be useful to supplement your pension income after you retire and before Social Security and required minimum distributions begin, or RMD. Now that we have covered our recommendation on the above-the-line deductions, let's move on to the below-the-line deductions, which are also known as itemized deductions. For 2019, the standard deduction for a couple that is married and filing jointly is $24,400. In order to qualify to itemize, your deductions must be greater than that amount. The Tax Cuts and Jobs Act of 2018 greatly increased the standard deduction and removed a number of itemized deductions that are available for individuals. Therefore, for 2019, we have listed the 5 that remain. The first deduction is for medical and dental expenses. To qualify, you must have unreimbursed expenses that exceed 10% of your AGI, or adjusted gross income. As you both are relatively healthy, this does not fit your current situation. The next is state and local taxes. As you live in the state of Texas, there are no state income taxes and local taxes amount to very little. The next deduction is for home mortgage interest. This deduction is only on the amount of interest you paid in the year for the first $750,000 of your mortgage. As your mortgage is below this threshold, you are available to use this deduction. The next deduction is for gifts to charity. Charitable contributions are limited to either 60%, 50%, 30%, or 20% of AGI, depending on a multitude of factors. As a general guideline, I will explain the basics of each percentage. If your gift is to a qualified charitable organization and is in cash, you can use 60% of AGI as a ceiling figure for your deduction. You are limited to 50% of AGI if you make a non-cash contribution to a 50% limit organization and 30% if you contribute capital gain property. Finally, you are limited to 20% of AGI if you make a capital gain property contribution to an organization within the second category of qualified organizations. Your current charitable contributions benefit the American Cancer Society, which is included in the 50% limit organizations list, which means that you could either use 60%, 50%, or 30% of AGI ceiling. We highly recommend donating highly appreciated assets to charity, as it can be beneficial in a few ways. This option allows you to remove these highly appreciated assets out of your portfolio without paying capital gains, and you can benefit from the charitable deduction that it provides. As you already have $16,250 for the year in itemized deductions, you only need about $8,000 more to balance with the standard deduction. Therefore, a charitable contribution of at least $10,000 from your brokerage account will satisfy covering the itemized deduction floor, as well as it would be safe from the limitations relating to the different percentages of AGI. The final itemized deduction available is for casualty and theft losses. These are currently only available to those affected by federal declared disasters. As we currently do not foresee you utilizing this deduction anytime soon, we suggest you stick to the two that you already qualify for, which is the home mortgage interest and gifts to charity deductions. While we have focused on 2019 for the previous slides, we'll now move on to the recommendations we've made throughout your financial plan that will have an impact on future taxes. The first change recommended is refinancing your mortgage so that you can fund education costs for your nephews. This change comes with a decrease in the amount of mortgage interest you will pay on a yearly basis by $3,000 for 2020. Over the life of the loan, you will pay more in interest, but the yearly amounts will be lower. The next change we recommend is starting to give money to a 529 plan for your nephews. Our recommendation of roughly $9,500 to the plan is well below the annual gift exclusion amount of $15,000, and the total amount given over time is also well below the lifetime gift exemption of $11.4 million. However, please note that the lifetime gift exemption provision is set to return to the previous amount at the end of 2025, which is roughly $5 million. We suggest that you keep a running total of all gifts that you've made over your lifetime in order to be below these limitations. Retirement is another area in which we made some recommendations and where you will run into other types of tax considerations. For example, during retirement, David will start receiving his pension payments. As these were placed in a pre-tax account, they will be considered ordinary income and subject to tax when payments are made. As your expenses decrease to $150,000 during retirement, you will need less income to cover those expenses. However, your pension is of roughly $122,000 will not be enough, and your Social Security payments will not apply until you are 70. In the meantime, we recommend using your newly established 457B plan to supplement income. One thing to mention is that during the period of 2025 until 2029, you should be in the 22% marginal tax bracket. As this lower tax will be beneficial, it is key to ensure that you stay below the $168,400 mark in income. During this time, it is advantageous to use any account that was pre-tax, which includes your pension, traditional IRA, and 457B account. In 2030, David's Social Security payments will begin and will increase your income again to the 24% tax bracket. Another important date to consider is April 1st, 2030, which is the date in which you must have taken your first required minimum distribution, or RMD for short. We have estimated this to be roughly $13,875 of income for that year. The final recommendation that we will cover is in regards to your investment within your brokerage account. As you can see in the side-by-side charts, your current portfolio consists mostly of large cap stocks. In order to create a more diversified portfolio, we recommend that you sell a good portion of your current holdings and buy other holdings that allow for less risk. We use a core and satellite approach to our investing for certain clients. As you are interested in following how your current portfolio performs in the future, we recommend selling 90% of those holdings and keeping the remaining 10% within a satellite portfolio. The core portfolio will be purchased with the funds that the sales gained. As you can see, the outcome is a well-diversified portfolio that matches your family's risk tolerance. Exact holdings, we recommend that you sell and buy to create the revised portfolio. If this transaction were to happen altogether, it would create a tax obligation of $120,150. Therefore, we are recommending that it is split between 2 calendar years, the first to happen in January 2020 and the second in 2021. The second chart is an estimation of the capital gains tax that would be due if the transaction were to happen in 1 year. But as we recommend that it happens over 2, this figure is just a basis to use for your tax planning for 2020. To conclude our presentation today, we have created a timeline that tracks from the year of in 2024 to the year David's RMDs begin in 2030. It highlights a few important years to remember. In conclusion, thank you, both David and Margaret, for coming in to discuss the tax planning section of your financial plan. I hope you found it helpful and that we can do this anytime for any other sections you may need clarification on. Also, thank you, Mr. Taylor, for joining us, and I look forward to working with you more in the future.